Welcome to the Deep Dive. Today, we're looking at something pretty staggering in the biotech space. NuCana, the ticker is NCNA. As of today, May 15th, 2025, it's trading at just 4 cents.
4 cents, yeah.
I mean, just think about that. 4 cents in ADS, and this is after hitting, nearly $11 within the past year.
$10.79 was the 52-week high. It's a dramatic fall.
Absolutely dramatic. So the big question is, what on earth happened? And maybe more importantly, is there any hope left for this company? We're talking about a UK-based firm focused on cancer treatments using their ProTide technology.
Exactly. And that's what we're going to unpack today. We've gone through their financials, news releases, analyst reports, everything we could find up to today, May 15th. Our mission really is to give you a clear view of NuCana from a value investing standpoint. We'll look at the business, the leadership, the financials, market feel, the risks, the whole picture.
Right. Give a concise understanding of where things stand and if there's any, potential value left.
Precisely. Provide clarity on their situation and what the future might or might not hold.
Okay, so let's start at the beginning. What exactly is NuCana's business? How do they operate?
Fundamentally, NuCana is what we call a clinical stage biopharma company. Their entire game is research and development, R&D. They're focused on creating new cancer drugs using their specific technology platform called ProTide.
Clinical stage meaning no actual products being sold yet.
Correct. They're pre-revenue, at least from product sales. They might get tiny bits from grants sometimes, but nothing substantial. Their whole operation runs on funding they raise, mostly by selling shares, like that recent $7 million offering we'll definitely talk about later. Their success hinges entirely on getting their experimental drugs through clinical trials, getting approvals from regulators like the FDA and EMA, and then hopefully selling them.
Either by themselves or maybe partnering up.
Exactly. Partnering with bigger pharma companies is often the route for smaller biotechs if they get good data.
Okay, so this ProTide technology is central. It sounds like they're trying to improve existing chemo drugs. Could you break that down a bit?
Yeah, that's the core idea. ProTide is their proprietary chemical method. They take existing chemotherapy drugs, specifically a class called nucleoside analogs, and they chemically tweak them. The goal is to create new versions, new chemical entities that are hopefully more effective and safer for patients. Basically, an upgrade.
An upgrade how? What's the supposed advantage?
They're trying to overcome common problems with chemo. Things like cancer cells becoming resistant or the drugs having really harsh side effects. The ProTide modification is designed to get more of the active drug inside the tumor cells where it needs to work and potentially bypass some of those resistance mechanisms.
Interesting. And has this kind of chemistry worked elsewhere?
It has, yeah. That's an important point. Similar chemistry has been successfully used, most notably by Gilead Sciences, in several major antiviral drugs. Think Sovaldi for Hep C, some HIV treatments, even Veklury for COVID-19. They use related approaches. So the chemistry itself has a track record, just not necessarily in NuCana's hands or specifically for cancer yet.
Right, so applying a proven concept from antivirals to the very different, very complex world of oncology. Makes sense. What are their main drug candidates using this tech right now?
Okay, their current pipeline really rests on two main candidates now. First is NuC3373. This is their ProTide version of a very common chemo drug called 5-fluorouracil, or 5-FU.
5-FU. Okay, I've heard of that one. Widely used.
Very widely used. NuC3373 is in a phase 1b/2 trial called NuTide.303. It's being tested in a couple of ways. One arm combines it with pembrolizumab, that's Merck's Keytruda, an immunotherapy for advanced solid tumors. Another arm combines it with docetaxel, another chemo drug for lung cancer.
And the hope is it works better than standard 5-FU.
That's the hope. Preclinical work suggested it might overcome 5-FU resistance and get higher levels of the active form inside cancer cells, but that's preclinical, early days still.
Got it. And the second candidate?
The other one is NuC7738. This is a ProTide of a natural compound called 3-dicyadenosine, also known as cordycepin. It works differently, aiming to mess with how cancer cells make proteins and affect the tumor microenvironment. It's in a phase 12 trial, too, NuTide.701. They're looking at it alone in various solid tumors and also combined with pembrolizumab specifically in melanoma.
Melanoma. Any results there?
They've reported some early data they called encouraging, particularly in melanoma patients whose cancer had stopped responding to PD-1 immunotherapies, which is a tough group to treat. And importantly, they have a composition of matter patent for NuC7738 in the U.S., which offers strong protection for the molecule itself.
Okay, two main shots on goal now. But you mentioned earlier, Aslern, that was further along, wasn't it? What's the story there?
Yes, Aslan. NUC did Neuro 31. That was their lead candidate for a while. It was a prototype version of another common chemo, gemcitabine. It got all the way to phase 3 testing for advanced biliary tract cancer, a nasty cancer of the bile ducts. The trial was called NuTide.121.
Phase 3, so the big, expensive final stage before approval, usually.
Exactly. And unfortunately, it failed. Back in March 2022, they announced it missed its primary endpoint, which was overall survival. Patients didn't live longer on Aslern compared to the standard treatment.
Ouch. Did it show any benefit at all?
It did show a higher objective response rate, meaning more tumors shrank, but crucially, that didn't translate into longer life for the patients.
And that's often the key hurdle for approval, right? Survival benefit.
It absolutely is, especially in oncology. So after that failure, NuCana pulled the plug on Aslern development entirely.
Wow. A huge setback, especially after getting orphan drug status in the EU for it.
A major blow, yes. Really highlights the risk. Even with promising early signs and designations, phase 3 is where many hopes die in biotech.
So with that failure and just the two main candidates left in earlier stages, where does NuCana actually sit in the market now? How big or maybe small are they?
Well, connecting that failure to their current standing, they're a microcap. NASDAQ listed, but tiny. Before that recent financing, their market cap was unbelievably low, like under $200,000. Even after raising $7 million with the stock at 4 cents, the pro forma market cap is maybe around $660,000.
$660,000?
Yeah.
For a publicly traded drug developer.
It's incredibly low. It screams market skepticism. They're a niche player in the huge competitive oncology field. High risk, potentially high reward, but right now the market sees mostly risk.
And that failure really hammered home the risk.
Absolutely. The Aslern outcome seems to have drastically lowered expectations for their other protides. And that recent financing, while necessary, just reinforces how tight things are.
Okay, let's zoom out. The overall oncology market. What are the big trends affecting a company like NuCana?
Well, the overall market is massive and growing. Aging population, rising cancer rates globally. A huge driver now is personalized medicine tailoring treatment to the tumor specifics. NuCana's idea of improving existing drugs sort of fits that theme of better, maybe less toxic options. And despite progress, there's still huge unmet need. We need better drugs, drugs that overcome resistance, that demand fuels innovation.
But it must be incredibly competitive. Who are they up against?
Ooh, intensely competitive. You've got the giants, big pharma, like Merck, who actually partners with them in that NUC 3-373 trial with Keytruda. These companies have vast resources, existing drugs, huge R&D budgets. Then you have countless other biotechs, large and small, all chasing breakthroughs in chemo, immunotherapy, targeted therapies, you name it.
And specifically for their drugs, NUC 3373 and NUC 7738.
Right. NUC 3373, the 5-FU protide, competes directly with standard 5-FU regimens and other new drugs for colorectal, lung, and other cancers where 5-FU is used. NUC 7738, the cordyceps one, is up against existing immunotherapies like anti-PD-1s, targeted drugs, especially in melanoma, and whatever else is coming through the pipeline for those tumor types.
Even with patents, others might be working on similar ideas.
It's possible. While their specific molecules are patented, the general idea of modifying existing drugs using similar chemistry isn't unique, as shown by Gilead. Others could be trying different modifications for cancer drugs. The bottom line is, even if their drugs are better, they need to be significantly better in survival, quality of life, side effects, to really displace current standards or beat other new therapies. Aslern showed that a better response rate isn't always enough.
And the regulatory path. Getting FDA or EMA approval must be tough.
Absolutely. It's long, expensive, and very rigorous. Preclinical tests, then phase 1 for safety, phase 2 for early efficacy, phase 3 for definitive proof against a comparator. Because these are modified drugs, they're treated as new chemical entities. They have to go through the whole 9 yards. Orphan drug status helps with things like fees and market exclusivity if you get approved, but it doesn't lower the bar for proving safety and efficacy.
So, given all that competition and the regulatory hurdles, do they have any kind of competitive advantage, an economic moat, as value investors say? What protects them?
That's the key question for long-term value. For a clinical-stage biotech like NuCana, traditional moats like brand recognition or economies of scale just don't apply yet.
No marketed products, no big factories.
Right. Their potential moat comes from their unique assets. That's the protide technology platform, which is patented, and the patents on the specific drug molecules like NUC 7738, plus their internal know-how. That intellectual property, IP, is supposed to be the barrier.
But how strong is that barrier now? after Eslerin?
Well, the Acelerin failure definitely weakened the perceived strength of that moat. The patents might stop someone copying their exact molecule, but if that molecule doesn't work or get approved, the patent isn't worth much economically. And as we said, the success in antivirals might even encourage others to try similar chemistry in oncology using different approaches. So the moat really relies entirely on their IP translating into successful, approved drugs. That's the only thing making them truly hard to replicate right now.
Okay, let's switch gears and look at the leadership. Who's running the show at NuCana?
The founder and CEO is Hugh S. Griffith. He's been CEO since 2008, so a long tenure. He has over 30 years in the industry, co-founded other biotechs, held senior roles at Abbott, Warner Lambert, which became Pfizer. He's also named as an inventor on many of their patents.
Yeah, on the medical side.
Their chief medical officer, Dr. Jeffrey Bloss, has deep oncology drug development experience over 20 years. Worked at big names like GSK, Genentech, Lilly. He's credited with contributing to the approval of more than 10 cancer drugs, including well-known ones like Gemzar and Tarceva.
So, experienced people. What about finance?
Well, their long-serving CFO, Donald Munoz, who was there for 9 years through the IPO and financings, left the company in February 2025. He joined another biotech.
Left recently. Is there a new CFO?
The information we had as of mid-May didn't name a permanent replacement. So that potentially leaves a gap in financial leadership at a very critical time.
Under Griffith's leadership, they raised money, got drugs into trials, but also saw the Acelerin failure and this huge stock price decline. Mixed bag.
Definitely a mixed bag. Success in raising capital and advancing candidates, yes. But ultimately, the major clinical setback and the destruction of shareholder value raise serious questions about strategic effectiveness.
How did management handle past crises, like that Acelerin failure?
Well, when the phase 3 failed, they did announce it publicly, detailed the results, and stated the decision to stop development. The CEO made a statement about reviewing the data and focusing on the remaining pipeline. It was a standard response, really. Pivot and focus resources elsewhere.
What about the stock price issues? Trading below $1 on NASDAQ.
Right. They faced that NASDAQ compliance problem. Their solution was a 1-for-25 reverse stock split back in April 2024 to boost the share price back over $1.
Which clearly didn't work long term, given the current price.
No, it didn't. And now they're facing that delisting risk again very seriously.
How transparent are they generally, communications-wise?
They seem pretty standard for a public biotech. Regular financial reports, press releases for clinical updates or corporate news, SEC filings available, an investor relations website. They did disclose the bad news about Acelerin in a timely way, so they appear to meet the basic disclosure requirements.
Okay, the really crucial question for investors. Are they honest? Are they capable? And are they really looking out for shareholders?
This gets to the heart of management assessment and value investing. Honesty. They seem to meet disclosure rules, yes, even with bad news. Capability, experienced team, innovative tech, definitely. But the track record is problematic now, with the Acelerin failure being a huge miss.
And shareholder-oriented. That seems like the big question mark.
That's where the serious concerns lie, absolutely. The stock price history is brutal, massive, prolonged value destruction. While biotechs need funding, the repeated dilutive financings, especially this latest one at such a low price, combined with the reverse split, these actions heavily dilute existing shareholders.
And CEO compensation versus performance.
That's often a point of contention. The CEO's pay, considering the long-term stock performance under his leadership, could definitely be questioned regarding alignment with shareholder interests. His ownership stake is quite small too, less than 1%.
So long tenure despite value destruction, dilutive financing. Raises governance questions.
It certainly could suggest issues with accountability or governance, yes. And the CFO leaving during this difficult period adds another layer of concern.
Let's look at where the money they did raise has gone. Capital allocation. Mostly R&D.
Overwhelmingly, yes. That's typical for this stage. R&D expenses were $18 million to 2024. That's actually down significantly from $25 million in 2023 and over $36 million in 2022.
Spending less on R&D, is that good or bad?
It likely reflects their tight funding situation and the need to focus resources after the Acelerin failure rather than increased efficiency. They probably just have less money to spend.
Any acquisitions? Buybacks? Dividends?
Acquisitions seem highly unlikely given their finances, despite boilerplate language in funding documents. No share buybacks, no dividends again. Totally normal for a pre-revenue biotech focused on research.
So how would you rate their effectiveness in using capital? Return on investment.
Metrics like return on invested capital, return on equity, return on assets, they've all been consistently deeply negative. It's been significant capital destruction. In terms of growing shareholder value, the capital allocation has unequivocally not been effective. The Acelyrin failure and current state are proof of that.
And that recent financing deal, selling shares so low.
The terms of that May 2025 deal, ADSs at about 65 cents, warrants with much higher exercise prices scream desperation. It suggests a very weak negotiating position, taking whatever terms they could get to stay afloat.
And the market reacted instantly.
Absolutely. The immediate price collapse to 4 cents shows the market saw it as highly dilutive and not a fix for the underlying problems.
You put together a summary table for capital allocation. What's the key takeaway there?
Table 1 really shows the story visually. Big R&D spend every year, increasing reliance on cash from financing selling stock to cover that spend. Despite raising money, cash balances generally trended down until this latest desperate infusion. And underpinning it all, large, consistent net losses year after year, high burn, no revenue. That's the core financial challenge.
Okay, let's dive deeper into that financial health now. What are the key metrics telling us as of mid-May 2025?
All right, looking at the numbers now, it's a picture of, frankly, severe financial distress. Market cap, as we said, incredibly low, around 660K post-offering. AP ratio, meaningless. They have negative earnings per share, significantly negative.
No revenue growth to speak of.
No meaningful product revenue, no. Profit margins, all deeply negative. Costs far outweigh income. Debt to equity looks low, maybe 3%, but that's misleading. It's low because the equity value has been wiped out by losses. They don't have much traditional loan debt, but they have operating liabilities.
And cash flow.
Consistently negative free cash flow. They burn cash just operating the business. Maybe the most telling metric is the price-to-book ratio. It's extraordinarily low, like 0.03.
Okay.
The market values the company at just 3% of its accounting book value. That shows an extreme lack of faith in the assets generating any future return.
So profitability, balance sheet strength, just not there.
Not even close, zero profitability, exceptional weak balance sheet. Even after the $7 million raise, it's precarious. End of 2024 figures showed only about 6.7 million pounds in cash, total equity of just under 6 million pounds against liabilities of nearly 9 million pounds. The recent cash helps temporarily, but at a huge cost to shareholders. It's not a strong foundation.
What about overall financial stability, consistency, debt management?
Well, they're consistently losing significant amounts of money year after year. That's the pattern for the last 5-10 years at least. No dividends, not expected. Debt-wise, they aren't overloaded with bank loans, but stability is very poor due to the cash burn and reliance on equity raises.
Working capital, enough cash to cover near-term bills.
At the end of 2024, their working capital was positive. Current ratio looked okay on paper, but a lot of current assets were receivables. Critically, before this latest financing, their cash was only projected to last into Q3 2025.
So the $7 million buys them a bit more time, but that's it.
Exactly. It extends the runway maybe to late 2025 or early 2026, but the fundamental need for more capital remains urgent. They are living financing to financing.
You also condensed the main financial statements, income statement, balance sheet, cash flow. What's the big picture from those tables?
Table 2, the income statement, just screams no revenue, big R&D spend leading to big operating and net losses. Table 3, the balance sheet, shows the thin cash buffer and tiny equity base compared to liabilities, even before the latest dilution. And Table 4, cash flow, highlights the cash drain from operations. They need financing cash just to stay afloat, and even that hasn't always stopped the cash balance from shrinking.
Okay, we've covered the business, the management, the very concerning financials. Let's shift to market sentiment. How is the market viewing NuCana right now? That 4-cent price tag suggests not well.
Not well is an understatement. Sentiment is overwhelmingly negative. Catastrophically negative, you could say. The dollar as a 4-cent price is the clearest signal. It puts them deep into penny stock territory, implies extreme risk, high volatility. We saw huge pre-market volume today, suggesting lots of speculation, maybe distress selling.
Any bulls left out there?
You might find some hopefuls on retail investor forums, but the broad market view is deep skepticism. Any automated undervalued flags you might see based on price to book are highly misleading here. They don't capture the fundamental risks.
What about the professional analysts? Are their ratings and price targets reflecting this reality?
It's a bit messy. A lot of the analyst targets you might find online are wildly outdated now. Some from early May were still showing average targets like $25.
$25 when it's trading at 4 cents.
Completely irrelevant now. Those were before the financing crash. More recent commentary is much more grounded and grim. We saw one analyst recently put a neutral rating on it, but with a $0 price target. That's about as bearish as you can get. There were downgrades last year, too.
What about those automated ratings, like from Zacks?
Algorithmic scores can sometimes look surprisingly good, maybe based on short-term price moves or simple metrics, but you have to take those with a huge grain of salt here. They often miss the deep fundamental issues. The most relevant analyst takes came after the May financing, highlighting the short runway extension and the severe dilution.
And that financing news itself, what was the immediate market reaction?
Devastating. The May 6th announcement of the $7 million offering just cratered the stock. Offering ADS is at 65 cents, already at discount, and then the price just falls off a cliff to 4 cents within days. That signals a total loss of confidence. The market basically said, this isn't enough, and it hurts existing shareholders way too much.
Were there any positive news items that failed to lift the stock?
They had their Q4 results in March, showing a slightly smaller loss, cash into Q3. Minor stock dip. They also announced some encouraging but very early data points for NUC 7738 and NUC 3373 late last year and early this year. None of it was enough to counter the negative tide, the financial worries, the Acelerin shadow. The financing news just overwhelmed everything else.
What about short sellers, people betting against the stock?
It's an interesting picture. The reported short interest, the official number of shares shorted, looked pretty low as of April. And this is a big quid, but the cost to borrow the shares to short them, the borrow fee rate, has been astronomically high. It peaked over 600% annualized recently, still around 280% today. Daily short volume is also high relative to total volume.
Low reported shorts, but super expensive to actually short it. What does that mean?
It suggests that while there isn't a massive crowd shorting it publicly, the people who are shorting it are very convinced it's going down further and are willing to pay a huge premium to maintain their bets. It's typical of very distressed stocks.
Options trading.
Likely minimal to non-existent at these price levels. Hard to trade options meaningfully on a 4-cent stock with this kind of volatility. It's a purely speculative, distressed environment for the stock itself.
Let's look at who owns the stock now. Institutions. Insiders, retail.
Institutional ownership is minimal. Very few institutions hold it, and their combined stake was tiny even before the latest dilution, maybe 6% then, probably closer to 2% now. Big names like Carlyle, Schoenfeld, Citadel might be listed, but they hold practically nothing in dollar terms now. Low institutional interest means less coverage, less liquidity. Pretty standard for distressed microcaps.
What about insiders? Management buying shares.
Insider holdings are also low. The CEO holds less than 1%. And crucially, there's been no reported open market buying by insiders in the past year. That's always a red flag. When the price is this low, if they believed, you'd hope they'd buy.
So mostly retail investors holding the bag.
It appears ownership is quite dispersed, likely dominated by retail investors and maybe some very early private investors. This lack of concentrated institutional ownership can sometimes weaken board accountability, too.
You have a table on the main shareholders. Does that confirm the picture?
Yes, Table 5 shows those few institutions like Carlyle, Schoenfeld, Acadian, Citadel with very small stakes pre-offering, and the CEO's sub 1% holding. The key takeaway is no major institutional player has significant skin in the game to push for change or provide stability. It's a dispersed ownership base.
All right, let's pull it all together with a risk assessment. You did a SWOT analysis, strengths, weaknesses, opportunities, threats. Lay it out for us.
Okay, the SWOT analysis really crystallizes things. Strengths. They do have the proprietary ProTide tech. It's scientifically interesting and had success in antivirals. They have the two lead candidates, NUC 3373 and NUC 7738, with some okay early data and a patent on 7738, and an experienced management team, on paper at least.
What are the weaknesses?
Oh, the weaknesses are overwhelming. Precarious financials, high losses, cash burn, short runway, the history of the major Acelerin clinical failure, massive shareholder value destruction, low market confidence, minimal institutional backing, heavy dependence on just those two pipeline drugs succeeding.
Any opportunities?
Sure, opportunities. Oncology is a huge market with unmet needs. If, and it's a massive if, they get truly positive clinical data that could be transformative, maybe lead to a partnership or buyout. They mentioned collaborations in the financing docs.
And the threats. Sounds like a long list.
A very long and serious list of threats. Clinical trial failure, always high risk in cancer. Inability to get more funding, that's an existential going concern risk.
Yeah.
Intense competition, regulatory delays or rejections, and that severe imminent NASDAQ delisting risk due to the stock price.
You also checked the impact of recent U.S. tariffs. Anything major there?
It seems pharmaceuticals are likely exempt from the main 2025 tariffs. Plus, the US-UK trade deal aims for secure pharma supply chains. So the direct threat looks low, indirect risks. Maybe higher costs for raw materials if sourced from tariff countries like China. General inflation impact on US operating costs. Retaliatory tariffs are possible but seem unlikely to hit NuCana hard directly. Overall, probably not their biggest worry right now.
What other key risks stand out?
Beyond those, it's really about 1. Clinical trial outcomes, binary risk, high chance of failure. 2. Financing risk, critical. Ongoing, can they keep the lights on? 3. Market risk and NASDAQ delisting severe, happening now. 4. IP risk challenges, scope, value depends entirely on drug success. You should expect to see a going concern warning in their next annual report, and the risk factors section in their financing filings, the F1, will spell out all these dangers in detail.
So, after going through all of that, what's the brief conclusion? NuCana as an investment today.
In summary, NuCana presents a deeply, deeply concerning investment profile right now. Clinical stage, reliant on Protide after a major failure with Aslerin. Finances are dire pre-revenue, high losses, low cash, reliant on dilutive funding that just crushed the stock price. Market cap is minuscule, sentiment overwhelmingly negative, analyst skepticism is high, institutions are largely absent. The risks, clinical failure, running out of money, NASDAQ delisting are severe and immediate.
Management experience doesn't outweigh the poor track record on value.
The experience is there, but the results for shareholders have been terrible. From a value investing perspective, this doesn't tick any boxes. There's no discernible intrinsic value here. Investing now is pure high-risk speculation on a low-probability clinical long shot. The potential for losing everything you invest is extremely high.
A very stark assessment. It really leads to a final thought. Given everything the history the current state does, that Protide technology itself still hold any real promise? Or have the execution failures and the market's brutal verdict effectively slammed the door shut on NuCana's story? Something to ponder.
A sobering question indeed.
Well, that wraps up our deep dive into the challenging situation at NuCana. Next time, we're shifting gears completely. We'll be analyzing a listener submission, a profitable, dividend-paying industrial giant. Could it be flying under the radar? It'll be a real contrast. Definitely tune in for that one.
Should be interesting.
If you found this analysis helpful, please do subscribe to the Stock Analytics AI YouTube channel. You won't want to miss our future deep dives. And the important disclaimer. This analysis is based on public information available as of May 15th, 2025. It's for informational purposes only. It is absolutely not financial advice.
Always do your own thorough research before making any investment decisions. We used publicly available data only, no insider information.
Thanks for joining us on the deep dive.